We have very little change in the Fed's statement. There's new language on the economy, but the bond purchase program continues at the $85 billion a month pace. And again, very insignificant, small, modest changes to the Fed's statement overall, despite some new language on the economy. Let me read to you about that first. There was also one dissent. Esther George did dissent. Information received since the Federal Open Market Committee met in January suggests a return to moderate economic growth following a pause late last year. Labor market conditions have shown signs of improvement in recent months, but the unemployment rate, the statement says, remains elevated. Household spending and business fixed investment advanced, and the housing sector has strengthened further, but fiscal policy has become somewhat more restrictive. That is new language, specifically referencing, we assume, sequestration, the budget battle. Inflation has been running somewhat below the committee's longer run objective, apart from temporary variations that largely reflect fluctuations in energy prices. Longer-term inflation expectations have remained stable. That inflation language remains consistent with the previous month. Now, again, the $85 billion in asset purchases does continue. The language there is the same. And let me read to you, again, the outlook with regard to those purchases going forward, a reiteration of what we heard from the past. The committee will continue its purchases of Treasury and agency mortgage-backed securities and employ its other policy tools as appropriate until the outlook for the labor market has improved substantially in a context of price stability. In determining the pace, the size, pace, and composition of its asset purchases, the committee will continue to take appropriate account of the likely efficacy and cost of such purchases, as well as the extent of progress towards its economic objectives. And again, Mark, the Fed maintaining its commitment to its accommodative monetary policy, that commitment to keep the record low federal funds rate consistent again until we see that improvement of unemployment to 6.5%, as well as, of course, keeping an eye on inflation as well. And again, the vote was not unanimous. Esther George voted against it. She was concerned that the continued high level of monetary accommodation increased the risks of future economic and financial imbalances and, over time, could cause an increase in long-term inflation expectations. So the message from the Fed with this policy decision is, again, steady as she goes, keep the pedal to the metal, and no big change in policy reflected in this latest Fed meeting.
And Peter, any changes in the Fed's economic projections?
We do have some modest changes there as well. Those are also being released at this time. Let me walk you through some of them. First of all, on the economic front, GDP for 2013, their central tendency now, the 19 Fed policymakers, not just the 12 voters, 2.3 to 2.8% for 2013. Prior, it was 2.3 to 3.0%. 2014, now, again, ratcheted down slightly, 2.9 to 3.4%. And in 2015, the central tendency rises to as high as 3.7%. On the unemployment rate, again, so critical to their decision-making with regard to monetary policy, 7.3 to 7.5% for this year, the new central tendency, down ever so slightly from what we saw previously, 2014, 6.7 to 7% unemployment. And we have unemployment in 2015 coming down to 6.5%, but not until 2015, according to the central tendency, these projections they put forward. And again, the biggest change with regard to inflation, Mark, reflected in their new projections, they dropped the core PCE for this year to 1.5 to 1.6% from 1.6 to 1.9% previously. And we also get at this time, as you know, also the expectations, the anonymous expectations for Fed policymakers as to what's going to happen with interest rates. Let me walk you through those very quickly here. Fed policymakers, 13 of them think that the first move for the Fed funds rate will be in 2015. That's consistent with what we saw previously. 4 say it'll be in 2014, so that tells you 15 don't think it'll be in 2014. And in terms of the pace of firming, it's again consistent with what we saw previously. 4 Fed policymakers think the Fed funds rate will be at 1% or higher by the end of 2014. 10 have the Fed funds rate at 1% or higher by the end of 2015. 9 still have it under 1% by the end of 2015, Mark, a little more than 2.5 years from now. So again, no major changes in Fed policy reflected in this statement and these projections.
Bloomberg's Chief Washington correspondent Peter Cook with that breaking news.